Paid on time, still down 80 points? That feels impossible until you realize your credit score is often grading a snapshot, not your intentions. If you also want to avoid the money patterns that quietly damage a normal financial life, this channel breaks down real personal finance traps every week. Most people think the danger is missing the due date. Sometimes it is. But one of the most expensive credit score mistakes happens earlier. Your card issuer can report a high balance before your payment is even due. So you pay on time, do nothing wrong, and still look risky for a few weeks. That matters when you are trying to qualify for an apartment, a car loan, a refinance, or even a job that checks credit. A temporary score drop can change the rate you get, the deposit you pay, or whether a lender asks extra questions. This video is for general education only. It is not investment, legal, tax, or personal financial advice. Credit scoring models vary, lenders use different systems, and your own situation may work differently. Today, we are breaking down 3 credit card timing mistakes that can cut your score fast, even when you believe you are being responsible. Then we will cover 3 moves that can protect your score without turning your life into a spreadsheet prison. First, you need one key idea. Your credit score does not wake up every morning and read your heart. It reacts to data that gets reported. For revolving credit, that often means the balance shown when your statement closes, not the balance you wish you had by the end of the month. Picture a card with a $2,000 limit. You charge groceries, gas, a utility bill, and one unexpected repair. By the time your statement closes, the balance is $1,600. That is 80% utilization on that card. You pay it down a week later, before the due date. From a cash flow perspective, you handled it. From a scoring perspective, the reported snapshot may still say 80%. That is why timing matters so much. Mistake number 1, using the due date as your only target. This is the mistake behind a huge number of "I paid on time, why did my score fall" moments. People are trained to think the due date is the only date that matters. The due date matters for avoiding late payments, interest, and account trouble. But the statement closing date is often the date that matters for what balance gets reported to the bureaus. Those are not always the same day. In many cases, the statement closes 2 to 3 weeks before the payment due date. That creates a gap. Inside that gap, you can still be on time and still have a high reported balance. Let us use a simple example. Say your paycheck hits on the 1st and the 15th. Your card statement closes on the 12th. Your payment due date is the 8th of the next month. On the 10th, you book a $600 flight, fill your tank, and pay a phone bill. On the 12th, your card reports a balance of $1,400 against a $2,000 limit. That is 70% utilization. You plan to pay it off with the paycheck on the 15th, so you feel safe. But for the next reporting cycle, the bureaus may only see the 70% snapshot. That temporary snapshot can matter more than people expect. If the rest of your file is young or thin, a utilization spike can hit harder. If you are about to apply for something, even a short score drop can become expensive. The practical lesson is not panic over every purchase. The lesson is that due date thinking is incomplete. If you only manage the due date, you may protect your account but still damage the picture lenders see. A better question is, what balance will exist when the statement closes? That one question changes behavior. You start making one small payment before the statement date instead of one big payment on the due date. You start checking large purchases against the reporting calendar. You stop assuming good intentions equal good reporting. Mistake number 2, watching total utilization but ignoring one card utilization. A lot of people hear the 30% rule and stop there. That advice is already too simplistic, but the deeper problem is this: your total utilization can look acceptable while one card still looks stressed. Imagine you have 4 cards with a total limit of $10,000. Overall, you are using $1,800. That sounds fine. 18% total utilization does not look terrible on paper. But now look closer. One card has a $1,000 limit, and it is sitting at $920 when the statement closes. Another card has a $6,000 limit and barely gets used. Total utilization looks calm. Individual utilization on that small card looks like a fire. Scoring models can react to both the overall picture and the stress on a single line. A lender reviewing your file can do the same thing with their own eyes. One nearly maxed out card often signals pressure, even when your combined limit says you are fine. This becomes a timing problem because the card that gets used for daily spending is often the exact card that reports a high balance first. Maybe it is the card linked to your grocery app. Maybe it is the one with the best cashback category. Maybe it is the one that auto-pays your streaming bundle, phone plan, and insurance premium. If that card closes before you move money around, it can report as dangerously full while your other cards sit mostly empty. Let us turn that into a real-world pattern. A person keeps 3 cards open. Card A has a $1,500 limit and gets used for everyday spending. Card B has a $4,000 limit and stays in a drawer. Card C has a $3,500 limit and only holds one subscription. Total balances stay under $2,000. Nothing feels out of control. But Card A reports at 85% every month because it gets paid after the statement closes. The person thinks, my total utilization is under 25%. I am doing okay. The model may disagree. This is why some people feel confused when they pay down debt and do not see the score improve the way they expected. They are fixing the total but leaving one line overcrowded at the reporting moment. The useful move here is not to obsess over tiny percentages. It is to identify which card tends to report hot. Then either pay that card earlier, spread spending across 2 cards before the statement closes, or move auto-pay bills away from the card with the smallest limit. Mistake number 3, letting a big purchase report right before an important application. This one hurts because it usually comes from normal life, not reckless behavior. Your fridge dies. Your car needs tires. You pay for a family trip before reimbursement arrives. Your pet has a sudden medical bill. You decide to put the expense on a card for points, float it for a week, and pay it off after payday. Under ordinary circumstances, that may be manageable. But if the statement closes before the payoff and you apply for credit while that high balance is showing, the timing can work against you. Now imagine the numbers. Your score normally sits around the low 700s. You are planning to apply for an auto loan next Thursday. On Monday, your card reports a balance jump from $200 to $2,400 on a $3,000 limit because you charged tires, insurance, and a hotel deposit. Nothing is late. Nothing is in collections. But the reported picture changed fast. A lender pulling that file this week may see a more stressed borrower than the one you actually are 2 weeks later. This is also where minimum payment autopay creates false confidence. People hear autopay and assume the system is handling everything. But minimum autopay mainly protects you from being late. It does not guarantee a low reported balance. If your card closes at 90% utilization and the minimum is only $40, autopay can preserve your payment history while still leaving your reported utilization sky high. That is why I am on autopay is not the same as my score is protected. So what should you do instead? Move number 1, learn your statement closing dates, not just your due dates. Most issuers show them in the app, on the PDF statement, or in account details. Write them down once. Put them in your calendar. If you use a card heavily, treat the closing date like a photo day. Whatever balance is standing there may become the picture that gets shared. Move number 2, make a pre-close payment when a card gets high. This is the simplest fix. If a card is heading toward a level that makes you uncomfortable, pay part of it before the statement closes instead of waiting for the due date. You are not trying to game the system with perfection. You are trying to stop one distorted snapshot from dominating your file. For some people, that means paying twice a month. For others, it means making one extra payment only in months with travel, repairs, or seasonal bills. The point is flexibility. Timing beats panic. Move number 3, Create an application buffer. If you know you will apply for an apartment, car loan, mortgage, or balance transfer soon, try to keep the 30 to 45 days before that application unusually clean. Avoid letting one card spike. Delay optional large charges if possible. Pay down hot cards before they report. Give your file time to look like your normal life, not your most expensive week. There is also a mindset shift here that matters. A lot of personal finance advice trains people to think only in monthly buckets. Income this month. Bills this month. Payment due this month. Credit scores are more sensitive than that. They react to sequence. Two people can spend the same amount and pay the same amount, yet the one who understands reporting timing may show a stronger score. That does not mean you should chase every point every week. It means you should stop confusing not late with optimized. Those are different standards. If your score has dropped recently even though you paid on time, ask these 3 questions before you assume something is broken. What balance reported on each card? Did one card close with much higher utilization than usual? Did a large purchase report right before a credit check or application window? Those questions solve a surprising number of mysteries. And if the answer is yes, the fix may be much more boring than people expect. Not a secret loophole. Not a new app. Not a credit hack. Just better timing, earlier payments, and less crowding on the wrong card at the wrong moment. Credit scores matter because they affect the price of future decisions. A score drop does not only hurt pride. It can make borrowing more expensive, raise deposits, or reduce options right when you need flexibility. That is why this topic belongs in a normal paycheck conversation. Credit damage is often not a morality story. It is a calendar story. Paid on time can still look risky if the report went out before the payment landed. If you want to keep spotting the quiet timing mistakes that make normal financial life more expensive, subscribe. Next, we will break down the bill date setup that causes many households to pay avoidable fees even when their income is technically enough. Tap subscribe so you do not miss it.